Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The US CPI has rocked the markets. Not only did it come higher than expectations, but it came higher than the previous inflation figures as well. What does it mean? Pushback against markets' rate cut expectations, and not just that, the US dollar strength has been felt across the currencies. USD JPY is above its psychological mark of 151, and good weakness is observed in other Asian FX pairs like the Korean won, Indonesian rupiah, which is trading at its 2020 lows against the US dollar. Morning, JK. Lot of events in the last 2 days. CPI rate decision by the ECB. Are there any clear trends emerging which has your eye?
Good morning, Swaraj. See what we are seeing in the last 10 to 15 days is that the US economy is definitely running hot. We had GDP number which came higher, then we had a very strong jobs report, much more jobs created than market was anticipating, and unemployment rate falling. And to top it all, we have CPI inflation, which has come very hot. Uh, Beating all expectations and also beating the previous month numbers. The main concern is that the super core services, that is services X energy, X housing, or have risen 0.65% month on month. And if you translate it, it's a very annual inflation will come to something like 7%. Of course, it is just one component, but those are not relenting at all, and therefore that is what keeps the policymakers worried. And even the cost of shelter has risen. We know that the energy costs have also been rising because of the crude prices, and all things point to your price pressures being on the upside, and that's really been the big market mover in the last 2 days. Of course, we had a PPI number, that is a wholesale price index, yesterday, that came slightly cooler, particularly on the month-on-month numbers. The PPI numbers generally have a lag effect on the CPI. So probably going forward, the optimists think that it can have a cooling effect on the CPI as well. But on the year-on-year basis, even PPI has been higher. We also had the Fed minutes, which was published on Wednesday night, which were members were, continually concerned that the progress towards inflation target has stalled, and restrictive monetary policy may need to be maintained for longer than anticipated. More evidence of US economy strength was seen in the jobless claims yesterday. 211,000 versus 222,000 that was seen last week, in another sign that economy is still doing well. Of course, there are some analysts who also already started to anticipate the PCE inflation, which of course Fed looks at closely, and they are expecting the PCE inflation actually to reflect somewhat lower price pressures, and so that's probably these PPI and the PCE number anticipation has actually cooled down the market. Otherwise, the market reaction immediately after the CPI was quite violent, and we had treasury yields that soared across the tenors. In fact, 2-year gained 24 basis points, 10-year 18 basis points, and 30-year 13 basis points. And these are very, very big moves. And in fact, if you look at, since the beginning of April, the 2-year has risen by about 40 basis points, and the 10s and 30s have risen by about 35 basis points. So the expectations on rate cuts are all over the place. But I think as of now, even the July cut has been, on the minority side. So September is the earliest that the market is expecting a rate cut. Whereas there are some hawkish analysts who have been even advocating a rate hike by the Fed in the end of the year. But my own view, being an election year, and also considering that the economy could struggle, such rate rises in the past have always resulted in deep recession for the US, and so there might be a preemptive rate cut, one rate cut by the Fed this year. by the time, well before the election, and then of course they might want to see how it behaves. So that's the outlook as far as the rate, our own outlook on the rate cuts are concerned. Stock markets did take a tumble. Higher for longer, playing out there, and again, some more profit taking by players because markets are trading quite at highs. But the cooling PPI numbers yesterday, had some people buying back, particularly the tech side, led the rally. Now, the bigger, move was seen in the US dollar that rallied strongly after the data, gaining more than 1% and maintained it even after the mixed PPI data yesterday. Japanese yen hit the multi-layered top at 152 and made a high of 153.3 plus, in yesterday's trading. Expectation of intervention on break of 152 have now been mellowed down because this has been seen as a fallout of overall dollar strength and not yen weakness. In fact, officials from Japanese side have also been saying they're still analyzing the reasons for the latest rise in the dollar yen. So then, they might well come and justify saying that the yen is not weak; it is the dollar strength because of inflation and all those things. Personally, I do see move further from these levels towards 155 is definitely likely to invite Japanese intervention. That is both because of the undervaluation of the currency and also fears that it may trigger a currency war. So that yen is continues to be focused. So far, yuan has not reacted much. Yuan fixing has been around the same level that we saw on Wednesday. Chinese authorities are so far going cool about these developments in the US. Therefore, even the offshore yuan is trading just above 7.25. Euro, interestingly, despite the US economy strong numbers and also ECB almost hinting at a rate cut in June ahead of Fed. It did not break the year's low at 1.0695 and has been trading above 1.07 steadily since yesterday evening. Of course, ECB president did mention data dependency approach for their actions, and also they've also been mentioning about the fact that US inflation is rising again may have them relook at their own assessment because there can be imported inflation that can affect them. And inwardly, I'm sure they are concerned about a slump in the euro value if they were to cut ahead of a Fed or cut more than the Fed. So these are things that they are, the policymakers are mulling about. Canadian dollar, of course, was another big loser after Canada also kept their rates unchanged, but did not really give any forward guidance. They were very non-committable about the rate moves. As I said, Chinese yuan has been holding up despite the fact that Chinese inflation numbers came softer. The softness was because in February it had risen due to holiday-inspired demand, boosting the prices, but it is back down to the same trend of falling prices and falling demand. Fitch also downgraded countries' long-term credit and foreign currency rating. All these things have not impacted the Chinese yuan. I feel that Chinese authorities are quite cautious, but they will not remain mute spectators if yen continues to slide further. And so that's the thing that we continue to watch. But what stands out most is the yellow metal, that is the gold, which has made even a new all-time high at 2390 today morning. Doesn't matter how much the yield rose, the gold has been on a one-way trip, and of course, geopolitical fears have been strong support for it. And also, I feel it's other factors like diversification and also, now higher interest rates eventually probably going to higher for longer, probably going to push US into a recession. These are the factors that could be that are definitely helping the yellow metal. So that bullishness is not ending soon. So we don't have too much data today. We have the Michigan initial survey, which will be on the focus. But on the Indian side, we had some strength based on flows on Wednesday. But US numbers have pushed the USD INR higher towards 83.40. Once again, yes, we are in the range between 83.20 or just under that to 83.50, and 83.15 and above. We have seen good consistent demand from PSU banks that's been on the that has been seen influencing the rupee, keeping it well supported as far as the dollar is concerned. We have the Indian CPI today. Again, expected slightly lower at 4.9 versus 5.09 that was last month. Core inflation expected to drop to 3.2% from 3.3%, but none of this will have a policy implication, because we higher growth and Fed policy uncertainty will keep the RBI on the sidelines as far as the monetary policy change is concerned. We will also have the trade number next week. So these are some things which will keep the rupee in oscillating between the range. And of course, the trade numbers are also expected to improve because of the global uncertainty and also the Fed policy and geopolitics. I think the central bank will continue to support the dollar on dips, and upside, of course, they will not let the currency fall to a new low until there is some big global trigger. Thank you.
Thank you, JK. And if I could summarize that, that would be that the US economy is running hot. That's the summary of the data that has been released in the recent days. Higher GDP, more jobs being created, and of course, a very hot CPI. This will keep the policymakers worried, and in fact, even creeping doubts about the rate cut, which was expected in June. And the Fed minutes also reiterated that there are concerns about the recent trend in inflation, and maybe progress towards inflation containment has stalled. That's a worry which Fed members have been reiterating. US dollar, meanwhile, has gained over 1%. There has been some weakness in yen, which may trigger some yuan weakness, but as of now, the recent yen weakness has not weakened the yuan significantly. Gold has made a new high. 2390 is the new all-time high. We are trading somewhere near that. And for rupee, US numbers, CPI numbers has pushed the rupee back towards the weaker end, which is towards 83.40. And we have got the Indian CPI data to be released today, and that will be something markets watch out for. That's it from us today. Thanks for listening. Have a good weekend. We'll see you all on Monday with the latest in the financial markets.